Hello and a very warm welcome to you. I'm Natalie MacDonald and you're watching Sydney Direct. As always, we constantly look to bring you new faces from Sydney's financial community, and today is no different. I'm talking to equities analyst Julia Lee from Bell Direct. Julia, thank you so much for taking the time to chat with us today.
My pleasure, Natalie.
Okay, so today's Thursday, the ASX rally really does continue post-RBA, but what I think we should remember is that outperformance did begin, in fact, before the interest rate cut. What's the big picture drivers at the moment?
I think in 2015 especially, it has been speculation around interest rates, and that speculation really has increased since the Bank of Canada cut its rates on the 21st of January. So if we have a look at the performance of some of the high-yielding income stocks on the Australian market since the 21st of January, we have seen stocks like Commonwealth Bank up by 6%, Telstra up by 5.5%, and even in the utility space, we've seen some of the utilities performing very well, with Duet Group up by 5.5%. So once again, it is those high yielding, the yield play story, which continues to outperform in 2015 and will probably continue to do so.
Now, the big banks are certainly leading the charge on that rally. As it starts to emerge which banks will be passing on those rate cuts to consumers and perhaps which won't be, could that translate into a performance divergence perhaps within the banking sector?
Certainly, I think ANZ has a little bit of an edge here because it does delay that interest rate cut announcement. So it means that it does make more profit while it's waiting to make that announcement. But really the drivers of the big banks, you'd have to say, is the yield at the moment. And in this respect, Commonwealth Bank is a little bit different. The other big four banks pay their dividends back in December and they go ex-dividend in November. However, Commonwealth Bank goes ex-dividend in February. So it has an upcoming dividend, and that should help to support share prices, as we've seen Commonwealth Bank reaching an all-time record high pretty much continuously since the start of the year. So we're expecting to see that bank well supported, and of course coming out with half-year numbers tomorrow, where we are expecting to see another record result.
The resources sector also certainly playing its part in this outperformance, but mining producers certainly still remain volatile. Is that volatility within the resources sector perhaps encouraging investors to diversify in their portfolios?
I think it is making investors very nervous, so they're probably reducing their exposure to the mining space, especially oil, when we have seen in the past 4 sessions oil prices rising 20% and then overnight dropping by 7%. So in the past week, we've seen a bull market in oil and then a correction in oil as well. So I think investors are reducing their exposure because of the volatility. And of course, low volatility is usually good news for investment returns. However, high volatility is usually bad news, and we are seeing high volatility in those areas. On the flip side though, high volatility, great news for traders, and those shorter term traders would be loving the volatility we're seeing at the moment.
This investor intoxication, you could almost call it, with the ASX, it can't last forever, as it were. I mean, we are looking at 10 straight gains at the moment, potentially even an 11th. It can continue for some time. But having said that, is there perhaps a safe stock that you might encourage maybe a more risk-averse investor to put their money in to wait for that potential dropout almost?
Natalie, I think the problem with the Australian market and all markets around the globe is at the moment is that everybody's doing the same thing. These trades are starting to get very crowded. The high yielding trade, the big macro themes that are being played. We have a look at the income stocks. They're moving pretty much in line with interest rate expectations or the bond market. We've seen the Aussie dollar falling. That's expected to continue. So that's another theme that investors can play through stocks like Amcor, Brambles, although these stocks have rallied quite hard, or through an exchange traded product, perhaps to gain exposure to the European and the US markets. So altogether, I think the Australian market, like other markets around the world, are playing these big macro themes. So some of the themes to be watching out for is that falling Australian dollar. Locally, the yield trade still very, very popular until markets start to price in interest rate rises. And then thirdly, just watch those countries adding liquidity to markets like China, like Japan, like Europe. These markets are probably likely to outperform.
Julia, thank you so much for your comments today. We look forward to chatting with you again soon.
Thanks, Natalie.
Our many thanks to Julia for her insight today, and we certainly look forward to hearing from her and the Bell Direct team more in the future. That is all we've got time for right now. However, do stay tuned to Dukascopy TV, as the team will be bringing you plenty more exclusive interviews and FX analysis. But for now, it's goodbye from me.